All right, so I'm running a little late on the June update. We've had a very busy month. Earlier this month, I was up in Northern California meeting with our existing investors and some new investors. Last week, we had the National Lending Expert Conference for the private lending industry, talk about what's going on in the industry, talk to other capital providers, talk to vendors that service the industry. Really just a big networking opportunity. So I'm getting the numbers out. Today we're gonna talk about what we earned in May. We're gonna talk about what our deal volume is looking like. We're gonna talk about some big changes that are occurring in the industry, specifically the amount of capital that has re-entered the marketplace. Obviously, we're not going into a recession right now. We don't see a housing market collapse. So all that money that kind of disappeared late last year, early this year, has re-entered the marketplace, putting a little pressure on pricing. It's more like kind of a price discovery process right now. We'll get into that. So let's go take a look at the numbers. All right, so this is going to be the June 2023 update for TaliMar Income Fund I. We're going to talk about the returns of the fund for May, and talk about what we're seeing in the month of June and what to expect in the second half of the year. Now, there's a lot of things going on in the marketplace that I want to cover. We're seeing a lot more liquidity coming back to the market after this bank liquidity crisis. You're starting to see transaction volume picking up, and I think that investor sentiment about the housing market has really jumped. So people are a lot more confident in the market. So first start off with some of our notable successes. First, we had a net 8.65% annualized return to the investor in the month of May. Now that's a little below what our target yield is of around 9%, but a couple of things that occurred. Number one, we had a little cash drag in the month of May. We had a lot of investor capital come in the month of May. And so the combo of those had driven down the yield. But we should see that jump back here in June. A couple other notable successes. We have no late payments in the fund in terms of 30-day lates and no defaults. We raised a record amount of capital in May. In fact, we raised over $6 million of new investor capital, and we're seeing just as strong of a June month as well. So we're bringing in a lot of capital. We're able to deploy it in really good loans here in the Southern California market. We surpassed 165 investors in the fund in May. In fact, we're now currently at 175 investors. So not only are we raising capital from our existing borrowers, but we're also raising capital from new borrowers, which is exciting as the word is getting out about the fund. And then we returned approximately a little over 318,000 to investors in May. That was an all-time high for us, and we will definitely be eclipsing that in June. So in terms of loan origination, May was not the greatest month for origination, just simply because of the lack of capital we had at the time for May. Now, we did raise a lot of capital, but it really came in at the second half of the month. So we were restricted to funding 3 loans for a total of $2.3 million. On average, we're typically around $5 to $6 million in total in closing. So we did about less than 50% of what our normal month would be. Average note rate of the loans we funded were 10.5%. Average LTV was at 70%. Now that's because we did a lot of fix and flip loans, which typically have a little higher of an LTV ratio. I like to be right in that 65% mark. Average duration was roughly 12 months. So we're keeping these loans shorter term right now. We're starting to look at maybe prolonging or extending loans in terms of having a longer duration with some type of interest mod maybe after 12 months or an escalator after 12 months, just so that we can keep more loans in the portfolio. Average duration, we talked about 12 months, and then loan position, obviously we're targeting first position loans. Loan origination, so this kind of gives you an idea of the last 12 months of loan origination. So May, June is just as the rates started to jump, and you saw a significant decline in loan originations during this period of time. Investors were getting a little uncomfortable about where the market was going. They were adjusting to the new rates, and so that's why you saw this dramatic decline in originations. For whatever reason, November, December, people started getting comfortable, especially here in San Diego, that the housing market wasn't going to collapse, and that in fact, right about this time, this December timeframe, is when values of real estate really started to recover. So December, you saw a big spike. Again, you've seen some decrease in volume. This right here is primarily because of the lack of capital that we have right now. So currently now we've got about 51 million in investor capital, and most of it's deployed. So what you see here is all money that we can raise for that month to redeploy that into the market. June is going to be you'll see a significant increase in June, though. We will definitely be above 5 million, again, because of the large capital raise in May. Loan originations, of the 3 loans we funded, 2 were fix and flip loans, so a little over $1 million on fix and flip. Bridge loans, we did $1.2 million. Real difference here, fix and flip and bridge. Fix and flip is the borrower's intending to add value and sell that property at some time in the future. Bridge loans we're just based on current value, either assisting a borrower with a refinance or a purchase. Loan servicing. Currently, or as of yesterday, we had 60 loans in the portfolio, totaling $48,505,000. Total average loan size, the average loan size is $808,000. It's funny because we just funded 3 loans today, so that's going to pop us up above 50 million. But this was of 6/21. Actually, that was that was Wednesday. Average LTV ratio of the portfolio, we're right in that kind of bogey mark where we want to be, 65% or 65% LTV. Average weighted coupon of the portfolio, we're at 8.96%. Should be popping up above 9% here shortly. Interest income over the whole portfolio right now is at $632,000. Average term, 12 months. And loans in default, actually, I'm going to take a step back. This is incorrect. This should be $332,000. I thought that was high. So interest income is $332,000. Average term is 12 months and 0 loans in default. Always like to highlight a success story. This was a bridge loan that we funded in January. Borrower came to us, had recently completed this new build. They needed to refinance their existing construction lender, so we took that construction lender out, actually gave them some funds out too, so they could work on some other projects they were involved with. Our loan size was $512,000. Bridge loan, first position at 10.5%. We underwrote it to 12 months at 65% of current value, and this was an appraised value up in McKinleyville, California. So we funded it in June. It actually paid off in May. Our underwriting value was at $789 with the actual payoff amount of being $935. So values of real estate generally have definitely recovered. I think most markets are still dealing with a lack of supply of housing, simply because we're not building enough and then people aren't selling their houses. So this is why I am so confident in this first position loans that we are funding. Let's look at the loan portfolio right now. Of the 48 million, we've got about 58% of that is in bridge loans. One of the things I like about bridge loans is that they're typically longer term duration. And if you're building a loan portfolio, you want to really start to focus on bringing in loans that are going to be on the portfolio a little longer. Now, in the past, I've always said, keep your loans short term, and that is true. However, if you do include an escalator, we call it an interest escalator in the loan, so that if rates increase, in the future, typically every 12 months we may reset the loan rate to a higher rate, and that will protect you against having a loan that has a interest rate that's below market. So really kind of an adjustable rate loan is kind of what I'm getting at. Fix and flip loans and fix and hold loans, they approximately make up about 40% of the portfolio. These loans are great. And again, I like these loans because the borrower is adding value, number one. And then number two, there's just a clear exit strategy. They want to sell that property as quick as possible. The downside to them are they are short term. So you're constantly having to recycle that money, finding another loan to replace it, which makes them a little difficult to manage. Loan portfolio, SFR, seem to really be our focus point. That's kind of where I want to be, single family and multifamily. So 76% of our portfolio is SFRs. You know, the multifamily, which is 5 units or above, really makes a small portion of our portfolio, but that's simply because of the price points here in San Diego. So we're funding loans between $250 to $3 million. And when you talk about multifamily in San Diego, you know, the average unit price is around $250 or higher. So on occasion, when these multifamily loan requests come across our desk, a lot of cases, they're just too big for our fund right now. But as the fund grows, we'll be able to chase after that property type. Industrial, and it's not restaurant, this is retail, is making up another about 18%, 19% of our portfolio. Industrial in San Diego is very strong. Again, it's a lack of supply of industrial properties. Typically, they're lower LTV ratios, and the borrowers are relatively sophisticated. Again, this is not restaurant. This is going to be retail. Again, if you're the right location for retail, is still very strong here in San Diego. Mortgage fund, let's look at the May stats. Average capital in May was at 43 million. Now consider that right now we're at about 51 million. So that just shows how much capital has come into the fund in just 30 days or so. Net interest income for May was at 318. Yield for May, as we had mentioned, is 8.65%. Year to date, yield to the investor just shy of 9%. So that's going to be our bogey. What we're focused on right now is to get that into 9%. And 12-month trailing average right now is at 8.29%. As I keep saying that this number is going to continue to climb. You know, when we look at what the returns of our portfolio were 12 months ago, they were significantly lower simply because that's where rates were at the time. You know, this is about the time that rates really started to increase quickly, and we'll see that as we go further on this year, this 12-month trailing average will catch up to this number. Mortgage fund. So currently, as of 6/21, as I mentioned, we're at 51,182,000 with 171 total active accounts. Investor returns, this kind of shows you where the returns have been over the last 12 months. We were sub 8% in May of 2022. May 2023, we're on the higher end of 8%. So those interest rates have really pushed up the return to the investor over the last 12 months. So moving forward, though, I don't think you're going to see such a large increase in rates, simply because you see a lot more liquidity in the market, and that has really put downward pressure on my ability to raise rates on the types of loans we're doing. You know, if you were to ask me 3 months ago, there really was just a total lack of liquidity in the marketplace, but institutional hard money lenders have come back into the market, so borrowers have more options right now to borrow from. Simply a supply and demand kind of equation there. Assets under management. In the mortgage fund as of May, we had 47 million in individual trust deeds. So these are legacy trust deeds that we had that have not paid off, and that makes up about 6.6 million. Market updates. As we all probably are aware, the Fed held interest rates steady in June, which to me was a little surprising. Which was even more surprising, though, is that they said to expect interest rate hikes moving forward. What I don't understand is why not just go ahead and continue with those rate hikes this month. Apparently, they felt that that was not the right thing to do. I imagine that they're trying to give local and regional banks more time to offload some of those assets that get negatively impacted when the Fed raises rates. Maybe give them a time to breathe and get those off their balance sheet. So what do I think moving forward? It's hard to tell. I still think we have inflation in the market that we need to continue to look to get under control. I give it a 50-50 chance if the Fed comes in and really raises rates in their next meeting, because I think you're starting to see inflation really come down quickly. And that kind of goes to my next point, which is in May, the inflation rate was about 4.05%. In April, that was 4.93%. So it was a pretty significant decrease between those two numbers. Now, some will argue, well, they're not measuring interest rates correctly, or I'm sorry, inflation correctly. Yes and no, but if they're staying consistent on what they're measuring, then I understand kind of what they're looking at. Unemployment rose slightly, and this is nominal. So, I mean, really, there was no change in unemployment. It's at 3.7% nationally. If you look to here in Southern California, it's going to be even lower. Home prices in San Diego or in California, median price was at $785,000. That's about a 6% drop year over year. Hate to use that year over year number, because just remember that we peaked about this time last year in home values. And this is just as rates started to really skyrocket. So it's hard to use last year this time as a measurement. But what it does tell you is, look, home prices have not really come down that much. Number of homes sold, this is staggering. It's number of homes sold this year compared to this time last year is down over 20%. Tough being a real estate agent or mortgage broker right now on the conventional side, simply because there just isn't enough housing for the number of buyers that are out there. Now, that's why, again, I am very confident in the markets that we are lending in. You just don't have enough housing to go around for the number of people that are looking for housing. So I think that is really what buffers us from any significant decrease in values, even if we should see some issues in the general economy. Days on market dropped to 26. I think we peaked out around the high 30, low 40 days. That was about November timeframe, and has just fallen since then. Most agents will tell you that they are getting multiple offers on the properties that they're marketing. So again, it just goes to show you the strength of most housing markets here in California. Housing market trends. I wanted to show this graph. It gives you an idea of where home values have gone over the last, this one is 5 years. So what I want to show you right here is, this was that November, December timeframe. This is the peak that we saw right in that May, June timeframe for the housing market. And you saw a drop in values, that housing values had dropped. Now, I don't know if it's so much that housing values dropped here. It's just that the type of housing price point, I think, really had an effect on this number, because the number of homes sold, as I mentioned on the prior slide, was down 22%, but it was actually this time last month. So if you looked at that number in May, it was down 35%. So, I think it might be just more of a situation where you just have fewer houses, being sold. But if you look at that November, December timeframe, that's when you start to see home prices really start to pick back up. And you're kind of getting right into that August timeframe that you're matching at for home values. And this is why I say it's really hard to measure, this time last year compared to what home values are today versus what they were 12 months ago. So discussion points, banks still remain cautious in their lending. They really want to build that liquidity base up. If the Fed does come in and raise rates further, they want to make sure that they are prepared. What has that done for us? Well, it has allowed us, or it has opened a big market for the private lending industry, because now borrowers who traditionally would have gone to banks are coming to the private lending industry to get their financing. Institutional capital is back, and it's back in a big way. I just got back from the National Lending Expert Conference here in San Diego. Again, the conference is really focused on private lenders and the vendors that service the marketplace. And I will tell you, every institutional lender was there with plenty of capital to be lending out. So that really is going to drive that growth that we saw over the last couple of months in interest rates. and probably should keep us steady in that 8.75% to 9% range for at least the foreseeable future. Office in some serious trouble in a number of markets. It is so true. We see office, especially Class C and B properties, having a really difficult time bringing new tenants in. It's not a property type that we focus on lending, so it doesn't really affect us, but it's something that we watch very closely. Financing for ground-up construction has caused new home starts to increase. So you're probably seeing some news that new home starts have really popped. That is the case, and that's just because the financing has come back. About June timeframe, new construction financing evaporated. Nobody could get new construction financing, but it's back. I'm getting calls from institutional lenders asking if we can broker any new construction loans to them. We don't really focus on them, but it just tells me that yes, there is money out there for new construction loans, and it should have a positive impact now on just general new construction. Real estate in the news. I wanted to highlight this. Home listings plummet as high mortgage rates tie owners down. This is one of the biggest reasons you see the number of listings down. Nobody wants to get out of their 2-3% interest rate loan to go out and buy a new home at 6.5% or 7%. So I think a lot of homeowners are sitting pretty on the homes that they're in, have plenty of equity in them. And again, that's going to be a big driver in why home values should remain pretty consistent, even if we see some volatility in the marketplace. Common questions I'm getting is interest income is taxed in the state of the individual taxpayer. So obviously we're getting a lot of new investors, and we're starting to see some of the same questions being asked. So just remember that because we're structured as a REIT, a real estate investment trust, you are going to receive dividends. And if you're using non-retirement funds, so you're going to all qualify for that 20% tax deduction. I'm kind of bleeding into point 2 here. And then if you're using non-retirement funds, remember, you're not going to be subject to this unrelated business income tax. What that is if you use retirement funds and you invest in an investment that uses debt, the income generated by the use of that debt will actually will result in you having a taxable event simply because it used debt. So you don't just get away from not having to pay taxes because you're using your IRA funds. You've got to make sure that whatever you're investing in isn't using debt, or you could be subject to ordinary income tax or capital gains. Because we're a REIT, we're not subject to UBIT. Everybody that invests in the fund that is non-retirement is eligible for that 20% tax deduction. And also, you are only subject to income tax in the state, or state income tax in the state that you file. We are not required to take any withholdings in the state of California. That's great news, obviously, for you low tax states or no tax states like Nevada, Arizona, Florida, Texas, Montana, some of those states that have low tax rates. Also, a big question is, hey, Brock, why do you have 2 portals? You've got the Verivest portal and the TaliMar Investor portal. Really, the biggest difference is the TaliMar Investor portal is set up so that you can see the performance of the mortgage fund. You can see the detail or general statistics of the fund. So you can look at it by property type. Really, all the tables I showed you in this PowerPoint presentation, you can view in real time. So as they get updated on my system, they get updated there on the portal. You can view it all real time through the portal, and you can actually get down to the loan level detail. I've also added a drop-down menu on the investor portal called Documents. It's up on the top right-hand corner. You can click that and now get access to the PPM, the private placement memorandum. You can get a copy of the subscription agreement. You can view our audit. And then if you want to invest through Schwab, that's one thing I forgot to mention, is that now we're approved on the Schwab and TD Ameritrade platform. You can download the forms to invest through Schwab and TD Ameritrade right there on the Documents tab. Fidelity, for those Fidelity investors, we're close behind. We're submitting the final documents to be approved on their platform. The Verivest portal is really there for you to get your monthly statements. Verivest is our fund administrator. They're the ones that do all the accounting. So they're the ones that issue those monthly statements that you get. So if you want to get your monthly statement, you're going to get there at Verivest. Promotions. So currently we still are running our $500 credit. If you open an account and invest $100,000, we'll go ahead and credit your account an extra $500. And if you refer any new investors, you will get a $250 gift card, and that investor simply has to open an account. There's no requirement to invest. Both these promotions run through June. I did forget to update that here. This is actually through the end of June. So with that, that concludes our monthly update for the month of June. If you have any questions about the update, about the fund, anything about it, feel free to give me a call. Best way to reach me is my phone number here, or catch me at my email address here. Appreciate taking the time to listen for our monthly update. I'll go ahead and get our next monthly update for the month of June, which I'm excited about. That update will come in mid-July. If you're enjoying a vacation for the summer, go ahead and enjoy that vacation, and we'll catch up in July. Talk to you soon.